Alan, so our group focuses on investing in the US, and we'll get into cross-border taxation in a moment, and you had great diagrams there we talked about. We'll have some questions there for you. But I want to focus on taxes related to real estate investing on this side of the border for Canadians. So my background is in construction and development. Could we briefly talk about what tax strategies exist? And so in particular, when it comes to real estate active investors or real estate developers, when they buy a real estate asset, they add certain type of value. If it's a renovation, if it's a building a project, if it's developing project, what kind of taxes are there? What kind of tax implications? What are the great structures to be used for local active real estate investors, and then we can make a comparison to the U.S. counterparts of that.
Sure. So let's take an example of an individual who'd like to buy a property, perhaps that needs some work, and they're going to renovate it and then sell it for a profit. That's considered a flip, and you are now in the business of trading real estate. What I would suggest that you do is, first of all, incorporate the business. Two reasons. Number one, you want to shield yourself from any personal liability if things go wrong. The second is taxation. Canadian corporations pay a very low rate of tax on active business income. Profits from flips are considered active business income. In fact, in the province of Ontario, the rate is approximately 12%. That's the combined federal and provincial rate on business income up to $500,000 per year. The second thing I would be careful about is financing, to make sure that you're working with someone who can ensure that the mortgage is arranged with the corporation. You'll likely have to give a personal guarantee, but that's fine, that's expected. And third, a lot of times individuals don't realize the HST implications. If it's considered a new build or new construction and not the resale of residential real estate, then HST applies. The buyer is going to say, well, I don't care, I'm just paying fair value for the home. The market price is the market price. And so that 13% HST is going to come out of your pocket, and that could really kill your margin. So one trick to be noteful of is that renovate the property less than 90%. So if you look at the floor space, keep one room aside so that you're below 90%. If you have renovated the property less than 90%, then it's not considered a new build. And as a result, it's considered the resale of residential property. And so HST would not apply to the sales price.